All right, we're back. Tax Review Commission, call the meeting to order. It's 2:30 Hawaii time, June 16th, 2026. This is a meeting of the Tax Review Commission. We're in person today for the first time, live and in living color. I'm really excited about that. This meeting was provided appropriate public notice under the Sunshine Law of the State of Hawaii. So I'll call the roll. This time in ascending order from your proximity to me. I'm first here. We don't have to announce that we're on a company, except for Jeff. Judy?
I'm here.
Jessica?
Here.
Mark?
Here.
John?
Present.
Stacy?
Here.
Excellent. And Jeff?
Present, alone in my office. Thank you.
You're here. Full house. Thanks for being here. We have a quorum for new business. All right, next up, communications to the commission. Are there any, did you receive anything by us?
We have not received any communication.
Cool. So just for anybody out there or anybody watching the recording, take public comment, written live. The information for that's on our webpage. So you can submit something written, or you can turn up at any of our meetings at the sound bar. Moving on. Minutes from last time. The minutes are part of the meeting materials. I think everyone's had an opportunity. Are there any changes to the minutes to be made? All right, I don't have any either. All right, so if there's, unless there's an objection, we'll consider the minutes approved. Good. Jeff? That was, all right. Cool. Minutes have been approved. All right, so that takes care of that. So next up, first substantive agenda item. We got a presentation from Nick Johnson. It's from ITEP, that's the Institute on Taxation and Economic Policy. They'll be presenting on regressivity. So last time and the time before that, I brought up that I might reach out to a couple of contacts about regressivity and see. This is the one I had in mind, ITEP specifically, and then I have another one in mind separately. So I didn't want to host a debate at the meeting, so that's why I've targeted different perspectives at separate meetings. So a little about Nick before he starts. He's a senior fellow with ITEP and their state and local policy team. He has several decades of experience in state and local tax policy. Also on the resume is a career with the Center on Budget and Policy Priorities, degrees from Duke University and Yale University, experience with the Washington, D.C. Tax Revision Commission, which sounds familiar, and more. And Nick is coming to us from Eastern time, I think. So that's why he's at the beginning of the agenda, so we can get started. But don't be shy about asking questions when he gets started. So Nick, thanks for joining us. We're looking forward to it. Please get started.
Yeah, really happy to be here. Thanks, Jonathan. Thanks, everybody. Just and just wave your hands or something if you have any trouble hearing me at any point. Or I think I just emailed you my cell phone number, Jonathan. So text me if there's any text issues while I'm going through my slides. Yep, I'm working on East Coast time, so I'm at home. So I just have my one screen in front of me, so I don't have like multiple monitors. So when I'm looking at the screen, I'll just be seeing my slides. But yeah, please don't hesitate to. I've got a few slides to walk you through on the topic of regressivity, and hope you won't feel any hesitation in asking me questions. As they say in the comedy world, I'm here all night. So let's go ahead and dive in. I'm going to share my screen. Technology willing. Okay. That's my organization, as Jonathan said. We're a nonprofit tax policy and advocacy organization based here in DC. And I'll say a little bit more as we go through the slides about one of the particular tools that we use, but we do work on tax policy, both at the national level and at the state and local level in all 50 states. And so today I'm going to talk a little bit about on the topic of regressivity in Hawaii, and so my contact information if you need any follow-up. I thought I would tackle three basic questions today. One is why would we want to be talking about tax regressivity? What is it? Why is it important? I'm going to share some research that we've done on how Hawaii measures up on this metric. and particularly taking into account the last couple of legislative sessions, and then some policy ideas and general strategic thoughts on how Hawaii might want to think about the challenge of tax regressivity. So very simply, tax incidence, tax regressivity is a measure of taxes as a share of income and how that varies as income rises. So the very simple sort of prototypical graphic here. On the left, you see an illustration of what a regressive tax system might look like. So with low income, each bar represents an income group. So as and with the poorer households in the left-hand income groups, the richer households in the right-hand income groups, and the bar represents the share of income paid in taxes. And you see that the income paid in taxes decline under a regressive tax. The share of income paid in taxes declines as income rises. A proportional tax system is one where each income group, on average, pays about the same amount of its income in taxes. A progressive tax is one where the amount of tax paid rises as a share of income as income rises. But why do we care about this? I think typically there are 4 reasons these come up for tax policy purposes and tax policy discussions. So one is that, quite simply, regressive tax systems deepen the divide between the wealthy and the poor. It's a fairly straightforward mathematical thing here, because it's measured as a percentage of income. A regressive tax system takes a higher share percentage of income from low income families than high income folks, and therefore after tax income, the gap between the rich and poor is wider than it is in before tax income. And this has a lot of socioeconomic consequences. It has consequences for public health. It has consequences for economic growth. There's some evidence that more egalitarian societies have better economic growth, and it has consequences for democracy. So aggressive tax system, by worsening the gap between the wealthy and the poor, can worsen public health, can undermine democracy, and can, under some circumstances, reduce economic performance. It also just strikes most people as unfair. If you ask people what's a fair tax system, one of their measures of fairness will be, does it tax the poor appropriately compared to how it taxes the rich? Most people, if you ask them, will say higher income people should be paying more taxes as a share of their income. Regressive tax systems hit people when they're down. We measure regressivity on a year-by-year basis. So a regressive tax system is one where, when in those years when people are poorer, they're paying more in taxes. A more progressive tax system, by contrast, has people pay more in those parts of their life when they can afford to pay more. The fourth thing about regressive tax system, that's probably the last one that comes to people's minds, is that a lot of regressive taxes are also not very good ways of raising revenue, which sort of makes sense if you think about it. It's that if you want to think about effective ways to raise revenue, going after those that have the least amount of resources is likely to be a fairly ineffective strategy. So you see, on a sort of year, and this is particularly true in periods of time, in eras that, like what we're in right now, where income inequality is increasing, where the rich are getting richer at a faster rate than other income groups. So if you have more progressive tax systems that's catching income at the top of the income level, you're going to be raising more revenue over time more effectively than if your tax system is mostly catching folks in the middle and the bottom of the income scale. So these are typically the reasons why we think, hey, regressivity might be something we want to think about. So we do a study, we've done 7 editions of a study that we call Who Pays, that actually tries to measure the taxes paid at different income levels. The tool we use for this is a microsimulation tax model. Such models are used by lots of different governmental organizations and private sector organizations who study tax policy. Essentially, what it involves is you have a sample of all taxpayers, you calculate the taxes they owe, and you then group those taxpayers by income group, and see how the taxes overall are hitting groups of taxpayers at different income levels. Our model includes a sample of taxpayers in all 50 states plus the District of Columbia. And we are able to model personal income taxes, consumption taxes, that's sales and excise taxes, property taxes, and taxes whose initial incidence is on business, but where we make some estimates of how those taxes flow through to the owners and the workers and the consumers, the customers of those businesses. So we actually our model currently covers almost all of the taxes that states and localities raise in the levy in the United States. We use data from the IRS. The original sample of taxpayers comes from the Internal Revenue Service that they provide for public use. We also then adjust that with census data, Bureau of Labor Statistics data. We adjust it with data that we obtain from state tax departments as well as federal agencies. And then we apply state tax law to that sample of taxpayers to calculate economic incidence. We also are able to use the model to do revenue estimates. And that's another very common use of microsimulation models. I'm not going to talk about revenue estimates today, but it is something that we use the microsimulation tax model for. So now let's talk for a minute about what we find for Hawaii. How does Hawaii measure up on this metric? So in our publication, Who Pays, the 7th edition of which we put out in January 2024, so reflecting all the laws that have been passed up through 2023, we found that Hawaii has a somewhat regressive tax system. It's actually fairly flat over the bottom 3 income quintiles, but then more regressive across the top 2 quintiles, and specifically going up to the top 1%. In this chart, so what you're seeing here is the cumulative impact of all of the different state and local taxes that are levied in Hawaii. So we've got an income tax, we've got a sales tax, specifically the general excise tax. We've got excise taxes on cigarette and fuel and everything else. We've got property taxes. And we've broken this out by income group. So at the very bottom of the chart, you see the annual incomes that correspond to each of these income groups. And one technical note I'll make: this is a study that, for this study, we focus specifically on non-elderly taxpayers. We find that seniors just have a different profile in terms of incomes and in terms of tax liability that makes it a little harder to see the pattern. We can also do analysis specifically focusing on seniors. It shows basically the same pattern, but it's a simpler way to break it down by quintiles if we just focus on non-elderly households. Like I said, within each of these bars is the different taxes. So I'm going to break down how these bars are composed in terms of the different types of income. So Hawaii's personal income tax is, as in most states with an income tax, it is the most progressive tax that you have. So if the only tax you levied was an income tax, it would be quite progressive. The top 1% would pay 6.8% of their incomes in tax. The poorest 20% of the population would pay just 5% of their incomes in taxes. And this is a result of a couple of key factors, the biggest one of which is Hawaii's use of a graduated income tax. So the marginal tax rates on income rise as income rises. It is also a result of some of the personal exemptions and standard deduction that Hawaii has. And it is a result of some of the low income tax credits that Hawaii offers. Hawaii offers refundable tax credits, earned income tax credit, as well as the tax credits that's used to offset sales taxes, which reduce taxes, particularly for the bottom two quintiles. I mentioned those refundable tax credits in particular because Hawaii actually makes less use of those kinds of tax credits than a lot of other states that have income taxes. So what a lot of states do is they actually use their income tax and the refundable credits that are delivered through the income tax. They provide these refunds that on net for the bottom quintile exceed income tax liability. And this is important when we get into the other kinds of taxes, because what that negative income tax does is it offsets the sales and property tax liability. So a lot of other states, a lot of other blue states, do have tax credits that exceed income tax liability. And then by exceeding income tax liability, they can serve to offset consumption taxes. And consumption taxes, as well as to a lesser degree property taxes, are quite regressive. And that's what's really driving the regressivity of the overall Hawaii tax system. By our calculations, the poorest 20% of Hawaii families pay several times over what the top 1% pays in excise taxes, and also pay more in property taxes. Just to say a little bit about the assumptions that underlie these. So in sales and excise taxes, this includes, you won't be surprised to hear the lower income families spend most of their income. They have very low savings rates, and so a lot of what they are spending their money on is subject to sales tax. Also in this is some business to business sales are passed through to consumers in the form of higher prices, and so those two wind up being borne by the poorest quintiles. By contrast, higher income taxpayers spend a lower share of their income on goods and services that are subject to sales taxes, and so they end up paying a lot less in sales and excise taxes. And property taxes, one of the key calculations that we make is that we assume that a share of the rent that is paid by people who rent their homes represents the property taxes that are paid by landlords. So that, again, the tax on a rental property, a portion of that is passed through to the renters. And that's one of the reasons, because low-income people spend a much higher share of their incomes on rent, that translates into a relatively high incidence of property taxes. So this is a little bit of a blizzard of numbers, but this is essentially the underlying data behind the three charts that I've just showed you. And I just want to point out a couple of things that I mentioned a second ago. One is under the sales and excise tax. Again, you see that the first line, the general sales tax individuals, that's the incidence of general excise tax on direct purchases by individuals and households. The bottom line, sales and excise tax, is on businesses. You see, to the extent that the general excise tax is paid by businesses, that also is passed through to consumers to a large degree, and so that also becomes a regressive tax. And then income, because Hawaii does not have particularly high use of refundable credits, as some other states do, the income tax actually adds to the overall taxes paid by the poorest quintile, the poorest couple of quintiles. In a state with a negative effective tax rate for those bottom quintiles, that would actually reduce the tax burden, the sales and excise taxes and the property taxes that are paid, that would offset those taxes, and you end up with a lower taxes for the bottom quintiles. So I'll say a couple of words about the tax bills that were passed in the last couple of sessions of the legislature to give you an illustration of how we use incidence analysis, how we think about regressivity in the context of policy changes. So, as you all know, 2 sessions ago, Act 46 was passed, and we estimate that that would have had, in dollar terms, Act 46 would have reduced the taxes paid by the bottom 20% of the Hawaii population by 2031. It's a little cut off there on the slide, but this is the distributional impact once the policy is fully phased in. We estimate that it would save the average household in the bottom 20% about $37 a year. For the top 1%, Act 46 would have saved them about $8,000 a year. When Act 46 was essentially amended by the bill that was passed this year, Senate Bill 3125, didn't change the impact on the bottom 20%, still a modest tax savings for that household. Didn't really change that tax savings for across most quintiles, but a steep reversal of how it handled the top 1% of households represents a significant tax increase by the time you get to 2031, instead of a significant decrease. And of course, that also has tremendous impact on the revenue implications. Again, I'm not talking about revenue implications, but that's what's driving this. Obviously, is Hawaii is providing a lot less in the way of tax cuts and therefore losing a lot less revenue under 3125 instead of Act 46. Just to put it in a little better context, if you then take those numbers and simply divide them by average income in those quintiles, you get a slightly different profile, but the same basic story. So the tax cut under either Act 46 or Senate Bill 3125 is about 1/4% of income across the bottom 20% of the population. For the top 1% of the population, you go from a tax cut equal to about 0.4% to a tax increase of about 0.305%. And so keep these numbers in mind, right? So you've got essentially a little bit of change here for the bottom 20% of the population, and almost 0.5 percentage point of income for the top 1%. We haven't done the calculations yet to show exactly how that would change the story on Hawaii's overall tax incidence. But roughly speaking, right, 0.4% of income at the top for that top quintile would take you up maybe to around 10.5% of income. For the bottom 20%, you're going from 14.1% of income down to 13-point-something% of income. So the point is that even though the legislation itself is somewhat progressive, it definitely reduces the regressivity of the overall Hawaii tax system. It will not eliminate the regressivity of the overall Hawaii tax system. So the basic story for our purposes is kind of the same. There is more that can be done to move Hawaii from having an overall regressive system to having an overall progressive tax system. So what can be done? Broadly speaking, I think there's 3 strategies to really be thinking about as you do your work in the tax commission. One is you want to be thinking about these tax credits for low and middle income families to offset sales and excise taxes. I know that's not one of the focuses of your review this time around, but I still think it's worth keeping in mind as you're thinking about the overall tax system, that while Hawaii's tax does offer tax credits for low and moderate and middle income families, they're not enough to take Hawaii out of the category of having fundamentally a regressive tax system. There's a lot of ways you could do this. You could increase the amount of credit. You could broaden eligibility, income eligibility measured in other ways. You could take steps to improve the take up. There's always folks that are missing out on these credits for various reasons. So that's one broad strategy to reduce regressivity, move in the direction of a more progressive system. A second is to think hard about the existing tax breaks for high income folks and also for profitable corporations. Typically, those tax breaks flow through to the owners of those corporations who tend to be relatively high income. And just think, are those tax breaks really doing their job? Are they really supporting economic development and investment? Could you identify tax breaks like that warrant repeal on the grounds of simplification, and thereby increase the fairness in the tax system? So even if you weren't doing it solely to drive to address the regressivity system, that would be one of the effects of curtailing some tax breaks like that. And then thirdly, I would say is that as you move in the direction of recommendations, you can consider doing formal analysis of the distributional implications of those recommendations. You can analyze them individually. You can analyze them as a package. And this is something where we would be happy to be helpful if we are able to we may be able to do some analysis of your recommendations as your process moves forward. I put that out just as an offer to be helpful. But I think you can't make decisions. Policymakers won't be able to make fully informed decisions about what you recommend unless they know what the implications are. And regressivity again is an important consideration always for policymakers. So they'll want to have that information in front of them to think about. And then I'll close with some specific policy ideas that flesh out those that sort of illustrate the strategies I mentioned again. So again, on the refundable tax credit front, two big ideas that a lot of states are looking hard at. One is a child tax credit. A number of states have enacted. The federal government offers a tax credit for every child, a refundable tax credit. And Hawaii could consider that as well. Hawaii also does already offer an earned income tax credit specifically for working families, mostly working families with children. This could be expanded. I think it's now 40% of the federal credit. A number of states have somewhat higher percentages. On the topic of sort of scrutinizing tax breaks for higher income individuals or for corporations that may not be doing the job that they were intended. One that falls into this category is an exemption called the QSBS exemption. It's QSBS stands for Qualified Small Business Stock, although it is not actually targeted to small businesses. It mostly benefits venture capitalists and other investors. Sorry. It's a federal tax break that was actually expanded in the Trump tax bill. Hawaii only conforms to it partially, so folks who live in Hawaii only are able to claim part of this exemption, but you could get rid of it entirely, and it would really have no effect on the appeal of business investments in Hawaii because it applies to investments all over the country. Essentially, you're subsidizing investors' investments anywhere in the country. You could look at taxing REITs, real estate investment trusts. Again, a lot of this is out-of-state investors. There's no particular reason why REITs shouldn't be subject to tax as other business entities are. You could look at a policy known as worldwide combined reporting that has been considered in Hawaii before, that can reduce the use of international tax shelters. And I know a perennial topic in Hawaii has been taxing capital gains income at the same rate as labor income. Hawaii is one of a relatively small number of states that offers a preferential tax rate for capital gains income. My point in mentioning all of these is simply to point out that as you're thinking, because I know that it is important to you all to be thinking about competitiveness, to be thinking about the economic implications, to be thinking about housing affordability. it's worth, it's always easy to think about what do we add to the tax system. But I think it's also worth considering, hey, how can we simplify things? How can we take things out of the tax system, unnecessary tax breaks that are contributing to regressivity that maybe just aren't doing the job that they're intended for? So with that, I will stop and see if you all have any questions. And I'll stop sharing my screen, but happy to go back to any of the slides if anyone wants to dig deeper.
Leave the screen. You can leave the slides up. I'm going to ask about a couple.
Okay. I'll do that.
Thanks, Nick. That's right on time, about 20 minutes. That's what I expected. That was a lot more Hawaii specific stuff than I expected from that. So that was pretty cool. Bars has a lot of that too. I think he could, I might have to check your work against his slides last week or last month. Very cool. Does anybody have any questions right now for Nick?
Maybe a simple one because I'm a simple guy, Nick. Is there a way to rank the regressivity of a state tax system vis-a-vis the other 50? I mean, is there,
Yeah.
just a simple way to like a, in inequality, you have a Gini coefficient. Do you have something like that in terms of how the tax burden is distributed in a simple number?
We do, and I should have shared it. And I don't have the actual calculation in front of me, but I know that Hawaii's roughly in the middle. I think we ranked Hawaii 22nd in this. It's a little tricky because, of course, the exact profile is going to look a little different from state to state. Some states are a little more, more of a straight line here. Some of it a little more of a bulb. But yeah, we have Hawaii at about, I think, the 22nd, the 22nd least regressive. So around in the middle, a little better than some. Other states have income tax. There are a few states that don't have an income tax at all. Obviously, those are some of the most regressive states. But there are other states, as I said, that make more use of refundable credits, that have more and less use of sales and excise taxes. And those would tend to make them closer to proportional or even somewhat progressive.
That's helpful.
But I can get you the specific metrics. I can forward those around when we get off the phone.
And you're saying sorry, one more.
Please.
You're saying you cover 99.5% of all state. Does that include everything like, I think you had mentioned cigarettes, liquor, gas. So those are all included in some sort of consumption modeling that you use?
Yeah, exactly. So we use the Bureau of Labor Statistics data on consumption, average consumption by household, and adjusted for, obviously, Hawaii has some unique profiles. So we adjusted for the Hawaii economy, and then we're able to model, not just both the incidence of general consumption taxes, but also the specific excise taxes, fuel, gasoline, cigarettes, all the others.
Got it. How about things like, estate taxes, which would be on the higher end, or
Right.
Let's say transfer fees for a sale of real estate or a car registration, which even though they're fees, I think of them as taxes. Are those included as well?
They typically are. We use the Census Bureau has definitions of what's a tax and what's a fee. And yeah, I agree. The line can be a little fuzzy, but certainly vehicle transfer taxes, vehicle license fees are considered taxes. And so we think about, we look at car ownership and how car ownership and the value of cars breaks out across the quintiles, and they were able to assign the tax based on that.
And estate taxes are also in this.
Estate taxes absolutely are in this. They are, they're fairly small in the sense that they only apply to, those households that pass away in a given, that have someone die in a particular year. So they're not a big chunk of this, but they are highly progressive. And yeah, I said that the income tax is the major progressive tax, but certainly the estate tax would be the most steeply progressive tax.
I have a comment just because you have that slide. You mentioned that you're excluding non-health elderly taxpayers, but
Mhm.
Hawaii does not tax social security or pension income. So that would actually make it look more progressive if you included the elderly, and we have a highly aging population.
Yeah, the
So-
challenge, the challenge with, just on a technical note, the challenge with including Hawaii in this particular presentation has to do with the different income brackets. So, families tend to have, families with children living in a house would tend to have somewhat higher income than a typical elderly family when you're sort of the downsizing. So it gives you a little bit of a misleading view. Yeah, so exempting certain kinds of retirement income can make the tax system somewhat more progressive. And on the other hand, um, for instance, a lot of senior citizens are benefiting, say, from the preferential tax rate for capital gains. So that kind of cuts the other way. And so I don't know, I can't say for sure that it would make that this look a lot more progressive um, if we somehow squeezed senior citizens into it. I suspect not terribly, because seniors are also the part of their lives where they are spending down, by definition, sort of spending down their savings, and so they are paying a lot of consumption taxes and property taxes.
So the people in the, I guess the sample population they're all families, like families with children. That's why the elderly are not generally with, like, families with kids. That's why they're not included.
This is all non-elderly tax filing units. So this includes single taxpayers. It's sort of a different, it becomes a different exercise when you're trying to analyze the incomes and the taxes of seniors. But we have a version of this that is for all taxpayers, and it does not look hugely different. I can get that to you as well if that would be helpful.
And what is your measure of income here?
It's broader than adjusted gross income. It is something closer to true economic income. So we're adding in a range of sources of income, everything from government transfers. We also are adding in income that is not subject to tax at all. So, for instance, I mentioned types of income that is distributed that is simply not taxed. All shows up in the income measure.
The reason I'm saying this is it matters a lot, right? So, like, as I said, the elderly, their Hawaii AGI is basically zero. Their income in our measures would be zero, and they would not be taxed. And
Right.
then,
No, we would include so in the
measures-
denominator, we would include Social Security and others. And so, for instance, we would include, cash assistance payments show up in this as income.
So do you have the age group in Hawaii, like the population? So maybe we can see what percentage of the population you actually included in this study.
Sorry,
That's
I want to be clear on this.
the population of the elderly. So what I'm saying is, since you have not included elderly in this study, so have you studied have the data for, like, the age group in Hawaii?
Yeah, I can pull that out for you. I don't have it at my fingertips. I'm gonna start writing a list of these follow-up ideas. These are good questions.
Yeah, sorry. Oh, you can go. Sorry, I have another question on the Hawaii state and local tax shares of family income, and how that chart breaks out, general sales, other sales and excise tax, and sales and excise business. So these lower income brackets, I guess, they have sales and excise taxes at 8.8%, which is, almost doubling our GET rate.
Right.
So I think it's higher. Like, if if a low-income family spent every dollar they had on purchasing something subject to GT, I guess is the amount in excess, the rate in excess of GT, that's because of like gasoline tax and stuff?
Yeah, it's
That's
a few,
about how much greater?
there's a few things going on here. So one is that a lot of low-income folks are actually spending more than they are getting in income. They are, literally eating their seed cords, spending down what assets they may have. That's part of it. Another part of it is that some of the GET is actually applied to purchases between businesses, and then those businesses build that into the sales price of the goods they end up sending on to consumers. And then a third item, as you said, is gasoline taxes, excise, other excise taxes. Someone mentioned vehicle transfer fees, all the sort of taxes that are labeled fees, business license fees, and so on that end up getting passed through to consumers. Those all end up showing up in that 8.8%.
Okay, and then like business to business, there are rates adjusted for GET. There's wholesale rates, and that's all taken into consideration. And the fact that GET is a tax on the right to do business, so it actually is passed out at 4.712, even though it's 4.5. So effectively, the GET on the GET collected becomes your 4.712. So is that taken into consideration, or is that like, I don't know if that's double counted, that the GT that the business pays is then taxed again
Right.
because it's actually passed out?
Yeah, no, I understand. Yeah, that's taken into account here because we match up our model is calibrated to the actual revenue that comes in the door. So we've got your reports from the Department of Revenue that show how much, or the Department of Tax that show how much tax is collected for the different taxes. Then we're actually calibrating to make sure we're matching up against that. So we should be showing the accurate amounts of tax as they're actually being paid by the businesses.
So
And then we'll
question,
take-
Nick. Oops,
Yeah.
sorry.
No, go ahead.
I was gonna change subject. I noticed for states that do have state sales taxes or GETs, they often have an exemption for food and drugs. In fact, I think almost great majority of them have that exemption. In your modeling, how much does that kind of exemption change the regressivity? Totally aside from how you'd cover the revenue hole, which is
Yeah.
something a problem, but I'm just curious.
Right. So there's two ways to think about it. It's because how you cover the revenue hole matters. So imagine one state that covered the revenue hole by just raising the sales tax rate. That wouldn't help very much. It would help some, certainly. Food consumed at home is a higher share of the budget for a low-income family than for a higher-income family. It's a higher share of what they spend their money on. But it wouldn't help that much. Now imagine another state that exempted food and replaced that revenue with a highly progressive income tax. That would make that would definitely make this tax system much more progressive. So it sort of depends on what the counterfactual is. But I generally say it's a grocery tax exemption will make your tax system a bit less regressive, but not as effectively as a more targeted benefit like your refundable tax credit that helps offset that.
Got it. So that's interesting. So that is more effective.
Yeah, I mean, yeah, I would argue in terms of regressivity, a targeted tax credit is going to be more effective as long as it's adequate, as long as it's large enough to do the job. But it's sort of dollar for dollar in terms of compared to the revenue you're giving up, because you're not giving a grocery tax exemption applies to to all households of all income. income levels. Everybody ultimately is buying some groceries, even though it's a tinier share of the income for high income folks.
And maybe my last question, I'm guessing this is kind of beyond your purview, certainly the studies. But one of the macro issues that we're dealing with in Hawaii is the economy has basically plateaued since the mid-90s, where we've got compounded annual growth in GDP and incomes here under sub 1%, while expenses continue to track inflation, if not more so. So competitiveness is a big issue for us, both in terms of stopping out migration, which cuts both ways, opportunity, but also maybe the cost of living, including taxes, but also attracting capital. So how do you think about that in the context of regressivity?
Yeah, two things. One is I tend to, so, it was mentioned I was the executive director of the DC Tax Revision Commission that just wrapped up its work a couple of years ago. And as a small, Hawaii is a small jurisdiction, a long ways from everywhere else. The District of Columbia is a small jurisdiction sandwiched between two other jurisdictions. So you have a lot of concern about border effects and businesses and individuals moving across borders and attracting capital in. And what we found is that both businesses and individuals, A, are a lot less mobile than we imagined, and B, a lot less sensitive to taxes than is sometimes portrayed. What's important to households, what's important to businesses are the fundamentals, whether it's for your family, quality of life, family connections, job opportunities, housing costs. For businesses, the availability of a workforce, access to transportation, and so on. So, tax policy is a pretty blunt tool for trying to deal with pretty complicated economic challenges. And so, when I think about that, and I think about regressivity, one of the things I try to think about is, well, what are the tools that we're using in tax policy? And that's why I sort of ticked off some of the policy suggestions I did, because I think some of those are things that potentially are not providing very much bang for the buck when it comes to competitiveness or comes to trying to attract some of the kinds of investments you may be trying to attract or retain the families that you're trying to retain. They may not be very effective, and they may be contributing to regressivity. So then you scratch your head and you say, well, maybe there's a different way to go about it. Maybe we could, without worsening regressivity, or maybe while improving the regressivity, we could think about a stronger tax system that doesn't have, is doing a better job of what we want it to be doing. Does that make sense?
Yeah, it does.
John, Stacy, Jeff.
I guess I have a question on one of the things that you said is that, improving, like, having more refundable tax credits, I guess, would address the regressivity of the general excise tax. But one of the things that I heard, and I think you even said it in this, is improving the take up of those refundable tax credits. I think there might be a challenge in actually getting individuals to file for them and apply for them.
Mm-hmm.
So what are some of the things that we could do to address that?
Yeah, and I haven't done a detailed analysis. I don't know what already Hawaii is doing. So forgive me if I suggest things that are already on the table. But it's everything from making sure that community tax clinics are well funded and adequately funded and are in the communities, reaching out to people. It is, making sure that the credits are large enough to motivate people to come in and do the paperwork. Making sure that the paperwork itself is as unburdensome, as undaunting. I think a lot of us that work in tax policy don't blink twice at the at the forms that are in front of us. We've sort of gotten inured to them. But you know, just coming in and having a conversation about taxes terrifies an awful lot of people, and they just don't want to do it. And if they don't have to do it, they don't want to do it. So thinking about creative ways to do that, integrating the applications into other kinds of forms that folks are already filling out. So, for instance, if some places have property tax credits, connecting those more directly to the property tax itself rather than making people fill out some kind of independent form. You know, there's a range of strategies, and I also think it's the case that nobody has perfectly. It's always going to be a challenge. It's always going to be work that should be, you know, that is going to be hard work at the implementation level. And you know, maybe we need to in some places, the tax department is not necessarily, you know, doesn't come into it with the staffing, with the expertise of outreach, and has to sort of develop new capacities, new skills, staff up in different ways to do the outreach. All of a sudden, you're doing outreach to get credits into the hands of families instead of doing what tax departments usually do, which is, you know, collect the taxes and make sure people know what their obligations are. Outreach kind of flips that on its head. So I don't want to pretend that it's easy or you just snap your fingers. I do think some states are. I know Maryland is doing some pretty interesting things on the outreach front. Massachusetts has some pretty sophisticated programs, so I think there are ways to improve it, and that can be one of the strategies to address regressivity. I also think, but I think by itself, simply saying, "Oh, we have to improve take up," is probably not going to be enough. You probably would have to also increase the size and expand eligibility a bit for the credits to really make a dent in regressivity.
I have only one thing. So, I mean, I you have several specific policies you mentioned. I can talk hours about them, so it's not fair. But the one thing I want to point out is behavioral responses, right? I mean, it's hard to account for them because we don't know. Think of this 13% top rate that has been enacted. It's 0.4% of the taxpayers, about 2,000 taxpayers. And if 10 of them move or change their residency, let's say to Florida, where they don't have to pay individual income taxes anymore, you actually lost more money than you know, just having enacted that 13% rate. So there are all these things that we're not capturing, right? So we look at a static thing and raising revenue or just changing under the assumption that people are not gonna change their behavior, and that's part of the challenge. Same thing with like let's say taxing real estate investment trusts. These are things that come up every year. They actually pay a lot of rent, and we do jurisdiction excise tax on rental income in Hawaii. So they actually generate more taxes that way by having rental income than having paid, you know, corporate taxes on the dividends paid out, because at the end of the day, their net operating losses are far exceeds, you know, the other deductions that they take, and they end up with zero taxable income. So if they were to change their investments to another state and distract from Hawaii, it could actually lead to not a revenue gain, but a revenue loss. I mean, these are all just examples, but they're, you know, this is a more academic debate maybe, but, and I'm not speaking on behalf of Department of Taxation, but just as an economist, you know, commenting.
Yeah, no, I think that's super important. You know, for our modeling, we do take into account behavioral responses when we are modeling the way taxes are passed through. That's one of the reasons that some of the general excise taxes we show up as falling to some extent on to a significant extent on consumers, is that we recognize the businesses have the ability to pass those through to consumers in the form of higher prices. So you do have to take into account behavioral responses. On the top, the top income tax rate, you absolutely have to consider the possibility that there will be some behavioral response. I would say that the most careful studies that have been done in other states reflecting their changes in top rates show very small, much smaller effects than you might imagine. I don't think any state that I've ever seen has actually found that it lost revenue when it raised revenue, or when it raised income taxes on the top. That's not to say it couldn't possibly happen, but it's not been the experience in other states. A couple of years, Massachusetts passed a millionaire's tax 2 years ago, and revenues from that tax are growing, far exceeding projections. So there is a body of evidence on that. Obviously in Hawaii, you face a number of unique economic challenges, and I'm way less qualified to speak to those than you are. But I think there's my general takeaway from all the research done on economic responses, behavior responses to taxes, is that a lot of times those responses are less than we expect them to be. And it has to do with all the other reasons that people and businesses conduct their lives the way that they do. They choose places to live based on, on where they want to live, not on tax rates, almost, the vast majority of the time.
All right, lively set of questions. Anybody else? Love it. All right. I had a couple, I think, that I kind of previewed to you when I talked to you about this. I think I'm going to pass on those. I think you covered those.
Okay.
When you talked about the negative, some states have a negative rate.
Mhm.
And Hawaii wasn't colored in on that map, but Hawaii has a refundable EITC. So when you talked about that, did you mean is there a different mechanism other than the EITC that's responsible for that negative rate?
No, it simply is. It simply means that in the states covered in particularly in dark blue, their EITC and their other refundable credits are just a lot larger relative to their consumption tax, relative to their overall income tax system than Hawaii's are. So, Hawaii families start paying income tax, actually start paying income tax at a somewhat lower income level, and they receive fewer in the way of income tax credits, refundable credits, than say. And I think New Mexico is a really good example. New Mexico has quite a large earned income tax credit. They also have the low income comprehensive tax rebate that is quite substantial. And taken together, those far exceed the income tax liability that folks in the bottom quintile pay. So it's simply a matter of relative scale, the size of the tax credit relative.
So instead of this being quintiles, if this was 10%, Hawaii might be colored in light blue or something. You know what I'm saying? Because when they change it to refundable, that costs, there was some people getting refunds. So it's got to be negative for some taxpayers.
Right. So we're talking, right. Part of it is, I see what you're saying. Right. So there are undoubtedly some groups of taxpayers, and I'm not an expert enough in exactly how Hawaii's credits map out, but there are undoubtedly some taxpayers for whom they are getting more back in refundable credits. But how many are those taxpayers, and how do they compare to those who aren't? So yeah, it might be, I don't know that, but it might also be that it would, the key ultimate question, I think, becomes not do you have it? I think this is just an illustration of a strategy, but the key question becomes, how does it balance? How do those refundable credits in the personal income tax balance out against the sales and excise taxes in order to create a sort of overall net tax for that bottom quintile that is lower.
All right. Any other questions? Ask the rest of Jeff, I haven't forgotten about you. Do you have any questions? All right. Well, we're at about an hour, so I think we can let Nick go if everybody's in agreement. All right. Ooh, thanks again, Nick, for being here.
Yeah, really appreciate the opportunity. Thanks for the good conversation. I got some follow-ups I'll send your way.
All right, cool.
Thank you.
Thanks, man.
Thank you.
Take care.
So before we started, I told some people here, that I kind of want to try to get out of here at like 4:15 because the staff, it'll help the staff out. They're ordinarily get out of here. So do y'all want to rock on? Or just-
I'm going forward.
Rock
All right,
on.
Rock on. All right. Yes. Unless there's objection, I'll reach out to my other contact. Another perspective on regressivity. Later meeting.
This was good though. Thank you.
I thought it was good. It was more Hawaii specific than I thought it was gonna be. I thought it was gonna be more like big picture concept policy, and I think that's what the other person. It'll be the opposite perspective more or less, but it'll be less like hard numbers for Hawaii. All right, so I'll try that for a future meeting. And then we can start trying to discuss if we want to say something in our report, as a finding or recommendation or something about regressivity or just, general discussion. So the next item on the agenda is any update from the evaluation committee regarding hiring of consultants or hero or anything. The pressure, I'm just curious.
I know there's been conversations with Bay Bars and Carl Bonham, I think.
Right, so I did talk with Carl Bonham, who's the executive director, and the economist, who is the public finance person there, Dylan Moore, who I worked with in the past doing academic research. So they're preparing a proposal to be able to address topics 1 and 2. And then they have a new faculty joining in August, who is expected to also be on board with this, and they're more than comfortable in addressing the request, and they have the expertise and other capabilities. So I feel hopeful that that's going to be helping matters to speed up the matters, but also having access to this good resource. So thanks, Mark, for initiating the contact. I think that does help.
All right. Well, thanks to the evaluation committee. Glad to delegate as much as I can. So I guess at some point we got to discuss what we do with the one that's posted. At what
Right.
make a decision about. That can just be an agenda item for next time if y'all want to. I'll have to. Self on the spot.
Right, I just wanted to see if we get, I just wanted to get a confirmation from you here. So I spoke with them on Friday. So, and then I spoke with our fiscal staff, and then they said we can just withdraw that notice. All right, there has not been any inquiries at all, sorry.
Looks good. Yeah. Sounds good. Excellent. Glad I put that on the agenda. I'll probably put that on the agenda every time just in case. So
Yes.
no pressure if there's not a.
Yeah, so the next thing would be, we get their proposal, and then we have to sign a memorandum of understanding, getting the specifics, but that will be, Judy, Mark, and myself, figuring out those details, and we would report at each meeting what's going on, and they'll hopefully make presentations as it leads up, and there'll be negotiations about that timeline as well.
So right now, I think we're still on the timeline.
Yes.
Yeah.
They said they can meet that deadlines we set out for them.
Get that new person that can crack the whip because he's new. He or whoever. So, yeah.
I think it's a tax expert too. Oh, perfect.
Yeah.
Cool. Any questions about that to the evaluation? All excellent. Unexpectedly excellent. So next up is continued discussion regarding the hearing. If y'all want to talk about that more, I think there was discussion last time about a couple of things, or a lot of things. We got to, one thing, which was maybe reaching out to House Finance, Senate Ways and Means, and trying to have a meeting, and try to stay in contact with them some kind of way going through the summer. And then the other thing we talked about is like taking some of their questions, or the questions they sent, and, you know, using that for some topic ideas and stuff like that. So I'm just filibustering here, setting it up. Anybody wanna go for it? Strong thoughts.
Decided how to communicate with them, just send a report, or do you think we should actually invite some of them to the meeting? Or just go through the emails, or what is the suggested?
Well, this is up to all y'all. But I mean, I can speak first if you want me to, or any of y'all can, if y'all have a strong opinion. But I think I made it clear last time how I come down on this, so I might be on the extreme one end, so if somebody wants to speak on the extreme other end. But I think what I would want to do is me or you or any member or two of us or something, just call Senator Dela Cruz's office and say, Tax Review Commission, we were confirmed, been doing business, we're about halfway through our timeline. You know, this is a courtesy. We want to kind of meet with the senator if we can. It's the chair of Ways and Means. Same thing with House Finance Chair. It's Chris Todd. I'm not sure. That is, and that's just because of the way I see what happened. I have an extreme. I think I might have an extreme interpretation compared to some of y'all, but I think that's enough. I think if I had
And the
to-
meeting is just to like kind of say, this is where we're at, right? This is what we're discussing, and kind of just informative, right?
it's informative
Not
from
to
our.
take direction.
Well, first of all, if the meeting happens, it's informative from our. 50-50, maybe 60-40, that the meeting doesn't even happen. You know, like I think, you know, I mean, I called the chair and vice chair of Ways and Means, and I didn't get a meeting with the chair at all. You know, his staff called, you know, emailed me back saying, "Oh, there's no concerns. We'll let you know if there's a." So I think there might not be a driving desire through the summer to get these reports, but we would be on record through the summer,
More as a courtesy.
reaching out, and I think so. That's my recommendation. I've talked for a long time.
Yeah, because from last hearing, there seemed like a lot of different directions they want us to study, but I think that this is, I mean, it's good that we stick with our topics and that we are informing them what we are doing. So what if they say, okay, so would you expand it and, you know, add some more topics, then what are we gonna do?
Yeah, so that's the danger of these kinds of, is that when we met in January, we didn't have time, and we don't have time now. So that's the danger. Is like, how do you thread that needle when you're up there in their office if the meeting gets taken? So yeah, you just have to dance, I guess. Say no some kind of way, or you know, I mean, we're covering a lot of the things that are involved in the questions already. And then if you look at the House concurrent resolution, you know, we're covering a lot of that kind of, a lot of those things too. And like new things coming out in the summer, I think we just have to figure out a way to politely say, we're giving you an update, and you can steer us a little bit. We can't just take like brand new topics.
Yeah, I guess at least we open the dialogue and then we want to show our efforts to try to communicate and to try to be lined up with what they are thinking what we should be doing, right? Yeah, so I think I'm just thinking we should do more like a communication with them at least up front, not wait until the next hearing or some meeting, then they will be like surprising us like.
Yeah, if we do nothing, then the next hearing, if we even get it, would be in January at the
Yeah.
very beginning of the session in the auditorium. Some mega information briefing probably with the department, as part of the departments. I'm not sure. I hunted the last Tax Review Commission. I couldn't find any evidence that they had a hearing like that because those were recorded and they're on YouTube. But the previous commission, I couldn't I was trying to find the dates to see if it's like in early January, if they do it at crossover in March, or when they do it, to try to figure out. What I have to do that. But I think it's a matter of us, if we start doing this in the summer, we can kind of plant the seed that we want to hear, or want an information briefing or something in January. And that would make it more likely to get, if that's something we want. So on that, does anybody have any strong opinions that we do something different than my perspective?
Oh, I think that's perfect. And the informational briefing would be to WHAM and House Finance, or the entire ledge? Not that the entire ledge would show up.
Yeah. I mean, sure, I think I sat in one when I worked here, when Kurt Calfucci did a briefing from the Council on Revenues, and it was in the auditorium, and I think it was joint Senate or Ways and Means and Finance committees. And then there were other people it was a bunch of legislators up there. There were chairs in the back, so there was like non-committee members too. So I think that's what if it was along with the departments, I think it would be, it would be like a House Finance and then Senate Ways and Means be separate. Any part of their budget briefing essentially are associated with that. All right, so
So that, so the confirmation hearing, like shortly after that was the passing of those bills, right, and stuff. So the big one is that 3125. And that had components of retroactivity to the solar, which that executive order just came out to say, kind of pull out the retroactive piece for concerns of, well, I mean, I'm sure the solar industry was vocal about it, and maybe concerns of any lawsuits related to retroactive nature of it. So this is just a thought that came to mind as, being the Tax Review Commission, and this, this bill has passed and subsequent to our confirmation hearing, and it does, I believe there are other retroactive pieces, I think, that has to do with expired credits being removed. And I think that's like I'm guessing the removal of it and it creating revenue is saying that the carry forward of the credit is gonna disappear. Is that what that's saying? So, that sort of is a retroactive piece too, right? It's something that taxpayers have earned historically, and the law was given to them that they are gonna get these credits to carry forward indefinitely. And then bill passes and we've got a few retroactive issues in there. And I don't know if there's someone that can speak on that, or on the issue of whether or not, like, you can do that, just to make sure that that there's nothing violating anything. Yes, I don't know.
you mean like checking on the ledge to make sure they didn't do something unconstitutional?
Well, I guess.
I don't know, man.
Yeah, I don't know. It just seems, a little bit like, I hope it's okay, just don't want to create any bigger, I mean, I don't know what the solar industry said that got the executive order to get rid of that piece. But just to make sure that it was just a thought, I just, yeah.
To make sure that nothing we recommend is gonna cause.
Nothing we recommend, and just to protect the state, I guess, in general, right, from anything, so.
So I want to make sure we know what to do. So you want to call House or Senate, and I'll call the other, since we got a chair and vice chair right here.
Sure.
All right, split it. All right. So which one you want? Which one you less scared of?
It doesn't matter.
All right.
I can go see that guy with whoever, city senator agrees with whoever sees him.
I'm gonna see him tonight.
Okay. Yeah.
At a fundraiser.
Tell him you got Judith Chalk getting ready.
Yeah.
So yeah, go Senate side and I'll
I can call, yeah, sure, Senate.
split that. All right. Got about 15-20 minutes. So next time, I remember I was just trying to figure out what in-house topics to go to next time. and to make sure we're prepped for that. So I know one that we had some detail on was the retirement income. You had specific things. I tried to push back on that, push back with like specific things. So I feel like we're prepared to like tackle that. And Jessica, you backed him up on that. So I think I'll be looking at y'all next time for like leadership on that topic. Cool. All right. And that, I feel like that's something that's a little more bite-sized than, something like, housing policy or regressivity or whatever. So we might start to get to a feel for what a recommendation look like there. So I'll have that on the agenda for next time. I'll try to have some talk. What other in-house topics should we start to talk about next time, or should we get prepared for next time?
So other thoughts that I had on the trying to, I guess, raise revenue was to think about the apportionment factors. Right now we do a 3-factor apportionment for multi-state businesses, but a lot of states are moving to single-factor sales, especially because brick and mortar is not as big of a fact. It's less and less, and brick and mortar is not and yeah, and payroll can, so I think if you're a Hawaii business, it kind of doesn't matter, but it would pull in a bigger apportionment factor for out of state, I think, if you go single factor sales. So it's
complicated. That's in my wheelhouse right there. Single sales factor, y'all want to study that?
So if it is, that's one thought, right? Because there's not a whole lot. There's less and less 3-factor apportionment going on. So yeah, and I think there's states that like I think with rentals they'll pull like sales and property. They'll pull out payroll and weight it differently. So I think it's something that we can look at that I think might be a little bite-sized topic too. That's something.
Is that in the state tax code?
Yeah.
Okay.
Yeah.
3 factors.
Just to back Jessica on this.
Yeah.
You can actually, they just passed a resolution for actually me to do a study on this.
Oh,
right. Single sales factor?
I mean, I'm saying me because it falls on me.
Yes.
They're supposed to do a study on different, I guess, corporate taxation methods.
I thought it was worldwide, or is it single sales factor?
Yeah, I mean, it just to kind of look at it comparatively. So
Like what the impact would be.
Relevant if Tax Review Commission studies this, it would definitely help. Just a side note. It's I have no impact on the commission itself, but just to point out.
All right, well, single sales factor.
Yeah, because there's so many like states moving to it. It must, to me, it must have a positive impact to revenue, but I don't know if.
Well,
Exactly.
it might have a positive impact to revenue. It was pushed by businesses to, basically essentially to exempt, a rough word, exempt the payroll of the property in the state. So and I think for some states it does increase revenue. I think for market states, like for a mega state like California, it might not, because there's so much property. But for Hawaii, it's a primary market state. So
Yeah.
but it was pushed as an economic thing, like don't tax to me, the 3-factor, and you can look back in 2019 and find my testimony to them to keep 3-factor.
Oh, we're on opposite ends.
Not anymore. I don't work here anymore. But basically you're taxing the factors of production or whatever, land, labor, capital, and entrepreneurship. The 3 factors, and then so the market picks up entrepreneurship. So single sales factor, you're cutting out those other factors of production. So I mean and I think that's the argument for it. That you don't tax that stuff. Don't tax that immovable stuff. So
But the apportionment factors, it's just to create the multiple against against the revenue to be apportioned, right?
It's not
So,
part of
Yeah.
so it's not saying that we're not taxing, you know, if they have payroll or.
Yeah, it's
Yeah,
a,
they're
it's
still-
exemption is, exempt is a rough
Yeah,
word.
yeah, yeah,
Just
okay,
take it out
got
of the fact. If somebody doesn't have, if somebody has a bunch of property and payroll in Hawaii and not a lot of sales, their tax is gonna go down. If somebody
Right,
else has, like
right.
Amazon has a ton of sales, but they have
Right.
a little bit,
Right.
their tax would go up.
And as more sales move online, I think that's what makes the single sales factor more precious to Hawaii. Because, and as far as like, if a business is all Hawaii, they could care less because they're 100% Hawaii. And so it's a way to raise revenue without hurting the Hawaii businesses. So you got your whatever Hawaii, you know, whatever Hawaii local businesses, they could care less because whether they have a 3-factor, all at 100% or only sales, it doesn't matter. But it pulls more revenue by pushing the apportionment factor from out of state companies. So I think, so that was one thing that I was thinking about. And the other thing that I thought of was we are a heavy real estate state, you know, appreciation in real estate. 1031 is very common, things like that. Other states are picking up on 1031 clawbacks. And I think that we could take a look at that too, potentially. And that clawback is that if you 1031 a Hawaii property and you take that deferred gain and you take it out to Texas or whatever, when you sell that property to a third party and you trigger the taxable sale, that Hawaii will claw back the deferred gain, the lesser of the deferred gain or the real recognized gain, you know.
California is like that.
Yeah, so California is one, and states are starting to pick up on it. And because our real estate appreciates like tremendously, you know, people take a lot of deferred gain. A lot of it, you know, will stay, but for people that do or businesses that do, take the money out of Hawaii and go to invest it out of state, you know, it's a potential to keep hold on that. So that was another thought on raising revenue without hurting Hawaii people that are, you know, just trying to do business in Hawaii. So
That's straight out of concurrent resolution. They talked about, they asked us to look at that kind of stuff.
oh really?
So, yeah, excellent.
Oh, okay.
I'll remember that when I talk to.
Oh, okay.
I've never heard of 1031 clawback, so.
Yeah, it's
So it'd be self-reported, basically.
so basically when you have a 1031.
Yeah, no, I
then you got-
understand, but I mean, if you sold it before the whole period, it'd be self-reporting back to Soh Tax
Yeah, and California
California
requires
requires
you
file.
to file every year.
every year.
So as long as it's not sold, you have to file the form to just say you still have it.
You still have
have it. So if the form only falls off, then it's a flag. So
Interesting.
once you report the 1031, if next year they don't see it, it's a flag. Like, hey,
And
did you?
and
did
it's
you-
it defaults to a collection notice.
Yeah, like, hey, you know what happened? You had a deferred.
Yeah.
Yeah.
I think that's a good idea.
So-
I mean, if administratively, I don't know how easy it is.
Yeah. So that was a couple of like bite-sized nuggets that maybe we can add on. Or
But if-
kind of more specific.
Well, just another idea, sorry.
No problem.
The tax, you know, how we start thinking about review of tax credits, you know, sunsetting. I know we're gonna ask UHERO to do that study, but I think we probably have enough here already to start thinking about it.
So this is.
Yeah.
This paragraph, but like. My version was, I'm just reading this, I wanna start brainstorming a framework. Is that what you're getting?
Exactly.
That's your words, like a framework for.
Yeah,
evaluating.
yeah,
I
yeah.
love that when you said that, like at the second meeting. So I guess now we got the old problem of triaging, so we want single sales factor on next month's agenda, or brainstorm some. Which combo of two of those three. Cause we're gonna start with retirement in it. And we're gonna have that on. the agenda.
I had another one I was thinking of too, raising revenue. Potentially, and it's an area that I dabble in, but formalizing making more public, like a voluntary disclosure program. I know we have the TIR, the state, but it's really not. It's not anonymous, it's not very user-friendly, but you know, if we do like a voluntary disclosure program for things, GT, income tax. Generates revenue, creates new revenue streams because taxpayers come into compliance. And it doesn't really hurt, because it seems like this administration doesn't want to raise taxes. Wants to kind of keep things where they are based on all the stuff they're doing. So, I don't know, something like a voluntary disclosure program, more public one. And I think what happens is if we offer a voluntary disclosure program, it makes it a lot easier when you catch guys later, because you gave them a chance, then you come into compliance, so. You know, department can be a little more hard.
Are you familiar with the MTC?
I am, but it's still not,
It's not
see,
enough.
federal has certain rules, you know, voluntary disclosure, MTC has their own. And state of Hawaii has a very loosely, you know, they just use this TIR
Right.
2020-03, so.
Very familiar with that.
So, but MTC does certain things you can do that you cannot do in the state, so it's something more uniform, maybe make it more user friendly. And something more public, because I think if you make it more public, then more people might come. Like I said, it brings in instant revenue and future revenue streams, so not really hurting taxpayers. Brings people into compliance. Not really a tax issue, but more of a policy kind of. I don't know.
Excellent. So yeah, these are all, I mean, I know I said earlier, if we have these meetings at the ledge and they want to do stuff, it's like we don't have time, but these are like single sales factor and the BDA thing. 1031 clawback I never heard of before. And brainstorming the credits and exemptions, we've had that list for I think those are just the right size for us to have time on. And I think it is good to have brainstormed a little bit on the framework of exemptions before we get just see how it supplements or end up with something completely different.
I think it would help us guide their work if we
Okay.
brainstorm it.
Along the way. That's another question I'd like to ask. Do y'all think that, this is for Judy and Mark, do y'all think that with UHERO we'll have more opportunity to sort of see the work as it happens and like get updates along the way? Like I felt like with an outside, the contractor would just be like, okay, we'll get the draft report and then we'll wait for the final.
I think if we build it into the engagement, like, however, report out at every meeting or.
Interaction.
How often do you want to have a check with those? Because that's the key to, I think the WAM chair was saying, how do you make sure consultants are doing their work and everything else? You got to keep them on a leash. So, how often would you want to check in?
I don't have a preference. I was just curious. I think y'all probably have. I have very little experience working contract, so I have no. It's up to you. I
would say at least monthly, maybe even like 3 weeks. That doesn't have to be all of us. It can just be a check-in. Some of us.
Cool. So we're running out of time. How about this? So next time, retirement income and
You want to take a stab at the framework, because then, once we set that, because then we might need to get data, right? So then if we kind of set the framework, then we can request data and work on the other stuff.
all right, so next time retirement, and we'll brainstorm framework for evaluating credits and exemptions, and then whatever else we'll talk about. And hopefully, other regressivity presentation. I didn't foresee that taking a whole hour, but it was a lively discussion. I was happy with that. Glad y'all asked a bunch of questions.
Single sales factor, we can also, I don't know when Babe, your study is gonna be.
I don't know. To be determined.
I do the same day our reports do, 30 days before the next legislative. Do you have till the next?
I think if they wanted this, I mean, yeah, same time as our
December 21st. All right. So that's the two, and in third place, single sales factor. Well, I will bring that up too next time.
So in a discussion about the pension income, is it possible to get a breakout of what the amounts are that are excluded on average? Because I think what we're trying to hit, going back to the legislature, I don't even want to, they have no appetite to tax the normal guy. So I'm thinking if we hit the number at a certain point where it won't affect most taxpayers, but it's going to hit the guys that, are excluding $150,000 pensions, maybe if we knew the number, like most guys exclude 60 grand. We don't want to do 60 grand. We want to go a little bit higher. Is there like data we have on that? Tax office?
Oh, it's a line item, so there should be, huh?
Yeah.
Cause it's,
Yeah,
but
it's
it's
separate
not
line.
like in a statement. It's not an other item. It's a line item.
Yeah,
So-
yeah. I mean, I'll look up what data we have so I can report back on that.
Okay.
So I think, yeah.
'Cause I think that'll help the discussion,
Yeah.
because what I'm looking at is, we definitely want to tax the state employees, and, we're looking at guys that got, these huge pensions that retire in Hawaii and they can exclude the entire amount. Maybe we capture a little bit of that.
Yeah, kind of bucket it. I don't know if it's possible, but between like public, like federal, DRS, like that, because that's kind of their own exclusion.
Yeah.
But the ones that are not, DRS, not federal,
SOPM, those.
yeah, not those.
I'll see what type of data we have and then so that can help also guiding.
Last thing we want to do is tax the state employees, so. Well, a lot of guys are state employees here, right? I don't think the legislature has any appetite. So,
I got to talking to senators about that.
yeah, I know that.
He had his staff in the meeting. It's like, she's gonna retire soon. You're not gonna tax her. Just one of many topics that came up at meetings with senators, including REITs and worldwide combined employment, and all kind of other stuff. Pension income. All right, so five bars will look for some data. We'll hear about that as we talk about and exactly what that data. If we don't have it next, if we don't have exactly. So about the next meeting, I think I'm comfortable right now with maintaining monthly. We not trying to go 2 weeks right now. So that would put us at like July 14th or something. We did Tuesday. So a month out would be around July 14th or July 1st.
July 14th week is good for us. I'm out the week of July 20th, so just, you don't need me, but.
Yeah, I'll be off the next week after that. So the week it would be July 28th, Tuesday. I'll be on the mainland that week. I could do a day that week, but I can't do that Tuesday. So the target date, I guess, would be July 14 or that week.
14 is good for.
I'm good.
Jeff says thumbs up, Mark says thumbs up, Jessica, Stacy, I see a lot of nods. Rick? John Knox. Final vote.
I'm a little at sea here. I might have come to the next meeting. I'm not quite sure what I'm doing.
You're welcome to. I mean, it's gonna be over Zoom. So,
Yeah. It won't be in person, so it won't be this fun. But sure.
Sure.
I guess I got an email. Judy got an email. I don't know who else got an email about John Knox participating in the whole thing. Maybe we should have that on the agenda next time. I always want to give us a quick.
Yeah. I should. Yeah, I should have. I mean, so John, thank you, John, for being here. He has agreed to share his expertise and experience as the topics come up to giving commentary and advisory role, right? to the consultants. Based on his past experience, he was the previous TRC chair and written some of the TRC reports and also the consulting work as well. Past tax review commissions. Is that fair?
Yeah.
Nice to meet you.
Right?
All right, July
Yeah,
14th at 2 p.m. July
Two,
14th.
okay.
2 to 4, right?
2 to 4.
Yeah.
You miss it.
Yeah, I mean, John is officially retired, but he is graciously with his, his support to the commission as an advisory role.
Note that the last time I had my head in tax things was 10 years ago. So I did a lot of tourism stuff thereafter until I retired.
Right.
I just got back from a safari to Kenya and I'm in a Shakespeare rehearsal tonight and this feels like, this is very different.
Yeah. Back in the South.
Right. Yeah, so that was the area that we kind of we're hoping that the tourism and
Okay.
the AT topic that can offer some advice to the consultants.
Oh, Chair, I might be a touch late on the 14th. I have a 1:30 to 2, and if it goes a little long, I might be a little late.
No problem at all.
2 to 2:30.
Two o'clock.
Can you hear me, Jeff? Yeah, no problem. I'll be a little late. Thanks for letting me know.
Yeah. Thank you.
No problem. So the only thing I want to mention, we're right on time, is next time I might try to talk about setting up the very last meeting because it can get really touchy at the very end. I know that from last time when I was a staff. So the report is due to be sent out on the 21st of December. That is a Monday, I think. So we won't be meeting on that day. Yeah, that's a Monday. TRC report. So sometime that week before or a couple weeks before that, we're gonna have to meet, just final vote. So just, I guess keep that in mind over the next month and talk about that next time. And just make sure we're able to sign on, at the very least to a remote meeting, sometime in mid-December to get a quorum and put it through so Rick can send it off on Monday.
Signatures, signature.
Yeah, yes.
Yeah, okay, so it's a wet signature, Rick?
A signature page for each commissioner.
Is it
Like
that
it's all-
signature or can it be electronic?
The last one we did all had to like get each person that didn't come. I changed them.
Yeah, I remember it was a wet signature last time, but I think so.
That's
I would just embargo the signatures, so you don't have to run around and get them on that day.
So we're just gonna check. to make sure.
Yeah, I mean, these days, yeah, we can do electronic signatures for most stuff, so we'll look into that.
You got time on the signature. But I already have scheduled a trip in December, so I'll make sure.
Yeah,
everybody
December
else-
is a hard time to
It gets-
get like
it gets
everybody
touchy.
together. It gets really.
So I can sign on from my main trip. Just a matter, it doesn't have to be in person. As long as we get those signatures before, whatever. But just something to be thinking about. It's tight at the end. All right, so anything else? I wanted to be out of here by about 4:15 to help the staff out. Cleaning up. Well, this has been really fun. I think this was, I feel this was more productive. Fun than, and so, I'll push to do it again. I think it was really, I don't know, I just feel more connected, in person. It's really cool. Jeff, you missed out. Next time. Rotation. All right, so, if there's not anything else. All right, cool. You're in the meeting at 4:11 p.m. Hawaii times. Take it easy, Jeff. See ya. We missed you. Peace.